Welcome to our video on the fundamentals of investing. Whether you're just starting out or looking to refresh your knowledge, understanding the basics of investing is crucial for building long-term wealth. In this video, we'll break down key concepts, explore different investment options, and help you develop a solid foundation. Investing isn't just for the wealthy or financial experts. Anyone can start with the right mindset and information. Let's begin by exploring what investing really means and why it's an essential part of financial planning. At its core, investing is the act of putting your money into assets with the expectation that they will grow in value over time. This could mean buying stocks, bonds, real estate, or even starting your own business. The goal is to make your money work for you, generating returns that can help you achieve your financial goals. Investing is different from saving, which typically involves setting money aside in a safe place. While saving is important for emergencies, investing helps your wealth grow over the long term. You might wonder why investing is so important. The main reason is inflation. Over time, the value of money decreases as prices rise. If you simply save your money, it may lose purchasing power. Investing allows your money to grow and potentially outpace inflation, helping you maintain or increase your wealth. Additionally, investing can help you reach major life goals, such as buying a home, funding education, or retiring comfortably. It's a powerful tool for securing your financial future. There are many different types of investments to choose from. The most common include stocks, bonds, mutual funds, real estate, and commodities like gold. Each type comes with its own risks and rewards. Stocks represent ownership in a company, while bonds are loans you make to governments or corporations. Mutual funds pool money from many investors to buy a variety of assets. Real estate involves buying property, and commodities are physical goods like oil or precious metal. Diversifying across different types can help manage risk. Stocks are one of the most popular investment options. When you buy a stock, you're purchasing a small piece of ownership in a company. If the company does well, the value of your stock may increase, and you might receive dividends payments from the company's profits. However, stocks can also be volatile, meaning their prices can rise and fall quickly. Understanding how stocks work is key to making informed investment decisions and building a balanced portfolio. Bonds are essentially loans you give to governments or corporations. In return, they promise to pay you back with interest over a set period. Bonds are generally considered less risky than stocks, but they also tend to offer lower returns. They can be a good choice for conservative investors or those looking to balance out riskier investments. By including bonds in your portfolio, you can create a more stable investment mix. Mutual funds allow you to invest in a collection of stocks, bonds, or other assets, all managed by a professional. This means you don't have to pick individual investments yourself. Instead, your money is pooled with other investors, and the fund manager makes decisions on your behalf. Mutual funds offer diversification and professional management, making them a popular choice for beginners and experienced investors alike. Real estate investing involves buying property, such as houses, apartments, or commercial buildings, with the goal of earning income or seeing the property's value increase. Real estate can provide steady cash flow through rent and potential appreciation over time. However, it also requires significant capital and ongoing management. It's important to research the market and understand the responsibilities involved before investing in real estate. Commodities are physical goods like gold, oil, or agricultural products that can be bought and sold. Investing in commodities can help diversify your portfolio and protect against inflation. However, prices can be volatile due to factors like supply and demand or global events. Commodities are often used by more experienced investors, but they can play a role in a well-rounded investment strategy. Every investment comes with some level of risk, the possibility that you could lose money. Generally, high-risk investments offer the potential for higher returns, while low-risk options provide more stability but less growth. Understanding your own risk tolerance is key to choosing the right investments. Balancing risk and return is a fundamental principle in building a successful investment portfolio. Diversification means spreading your investments across different types of assets, industries, or regions. This helps reduce the impact if one investment performs poorly. For example, if you own both stocks and bonds, a drop in the stock market might be balanced by stable bond returns. Diversification is a key strategy for managing risk and achieving more consistent results over time. Before you start investing, it's important to set clear goals. Are you saving for retirement, a home, or your child's education? Knowing your objectives will help you choose the right investments and stay motivated. Set specific, measurable, achievable, relevant, and time-bound, SMART goals to guide your investment decisions and track your progress. Your time horizon is the length of time you plan to invest before needing the money. Short-term goals might require safer investments, while long-term goals can handle more risk. Understanding your time horizon helps you select the right mix of assets and manage your expectations for returns and volatility. Risk tolerance refers to how much risk you're comfortable taking with your investments. Some people can handle big swings in value while others prefer stability. Assessing your risk tolerance helps you build a portfolio that matches your comfort level and financial goals. It's important to be honest with yourself and adjust your strategy as your situation changes. Portfolio is simply a collection of your investments. Building a well-balanced portfolio involves choosing a mix of assets that align with your goals, risk tolerance, and time horizon. Regularly reviewing and adjusting your portfolio ensures it stays on track as your needs and market conditions change. Compounding is the process where your investment earnings generate their own earnings over time. This snowball effect can significantly boost your wealth, especially when you start early and reinvest your returns. Even small, regular investments can grow into substantial amounts thanks to compounding. It's one of the most powerful tools in investing. Active investing involves frequently buying and selling assets to try to outperform the market. Passive investing, on the other hand, means holding investments for the long term, often through index funds that track the market. Each approach has its pros and cons, and the right choice depends on your goals, time, and interest in managing your investments. All investments come with costs such as management fees, commissions, or transaction charges. These fees can eat into your returns over time, so it's important to understand what you're paying and look for low-cost options when possible. Even small differences in fees can add up significantly over the years. Investing isn't just about numbers, it's also about managing your emotions. Fear and greed can lead to poor decisions like selling during a market drop or chasing hot trends. Staying disciplined and sticking to your plan is essential for long-term success. Remember, markets go up and down, but patience and consistency often pay off. Financial markets naturally rise and fall over time. These ups and downs are called market fluctuations. While it's normal to feel uneasy during downturns, it's important to remember that markets have historically recovered and grown over the long term. Staying invested and focusing on your goals can help you weather short-term volatility. Before investing, take the time to research your options. Understand what you're investing in, how it works, and the risks involved. Reliable information helps you make better decisions and avoid common pitfalls. Use trusted sources and don't rush into investments you don't fully understand. You don't need a lot of money to begin investing. Many platforms allow you to start with small amounts and build your portfolio over time. The key is to get started and develop good habits early. Consistent investing, even with modest sums, can lead to significant growth thanks to compounding. Automation can make investing easier and more consistent. Many services let you set up automatic contributions, so money is regularly invested without you having to think about it. This helps you stay disciplined and take advantage of dollar-cost averaging, which can reduce the impact of market volatility. Regularly reviewing your investments is important to ensure they still match your goals and risk tolerance. Life circumstances and market conditions change, so it's wise to check your portfolio at least once a year and make adjustments as needed. This keeps your investment strategy on track. Many new investors make mistakes like chasing hot stocks, ignoring fees, or failing to diversify. Learning from these common errors can help you avoid costly setbacks. Focus on your long-term goals, do your research, and stick to your plan for the best chance of success. The investment world is always changing. Staying informed about market trends, economic news, and new investment products can help you make better decisions. Subscribe to reputable financial news sources and continue learning to keep your knowledge up to date. If you're unsure about where to start or how to build your portfolio, consider seeking advice from a financial professional. Advisors can help you clarify your goals, assess your risk tolerance, and create a personalized investment plan. Just make sure to choose someone with the right credentials and a good reputation. Taxes can affect your investment returns, so it's important to understand how different investments are taxed. Some accounts offer tax advantages like retirement accounts, while others may require you to pay taxes on gains or dividends. Planning ahead can help you keep more of your earnings. Investing is a long-term journey. Markets will have ups and downs, but staying patient and sticking to your plan is often the best strategy. Avoid making impulsive decisions based on short-term market movements. Over time, patience and consistency can lead to rewarding results. You've covered the fundamentals of investing, from understanding different asset types to managing risk and building a portfolio. Remember, successful investing is about setting clear goals, staying informed, and being disciplined. Start small, keep learning, and review your progress regularly. With the right approach, you can build wealth and achieve your financial dreams.